Have you ever wished you could control a stock without owning it? Options trading offers that opportunity. It's a powerful tool for investors of all levels. Let's dive in and unlock the world of options trading. Before you can trade options, you need to understand the basics. An option is a contract giving you the right to buy or sell an asset at a specific price within a set period. Think of it like buying insurance for your investments. There are two main types of options, calls and puts. A call option gives you the right to buy an asset at a certain price. A put option gives you the right to sell an asset at a certain price. Options can seem complicated at first glance, but they're really quite simple. Think of an option as a coupon for a stock, giving you the right to buy or sell at a certain price, called the strike price, until a certain date, the expiration date. You pay a fee for this coupon, called the premium. Let's say you buy a call option for Apple stock with a strike price of $150 and an expiration date 1 month from now. You pay a premium of $5 per share. If Apple's price goes up to $160, you can exercise your option, buy at $150, and sell at $160, making a profit. Options trading can be a powerful tool when understood correctly. Call options are like bets that a stock's price will go up. If the stock price rises above the strike price before the expiration date, you can buy at the lower strike price and sell at the higher market price. The more the stock price goes up, the more profit you make. However, if the stock price stays below the strike price, your option will expire worthless and you'll lose the premium you paid. Call options allow you to control more shares with a smaller investment than buying the stock outright. Put options are the opposite of call options. They're like bets that a stock's price will go down. If the stock price falls below the strike price before the expiration date, you can buy at the lower market price and sell at the higher strike price. The more the stock price drops, the more profit you make. Put options offer leveraged returns but come with the risk of losing your entire premium if the market moves against you. Options offer flexibility that traditional stock trading doesn't. You're not obligated to buy or sell the underlying asset. You can choose to let the option expire worthless. This flexibility allows you to tailor your trades to your specific market outlook and risk tolerance. Understanding the different types of options and how they work is just the first step. Before you start trading options, you need to learn the lingo. Understanding terms like strike price, premium, and expiration date is crucial for making informed decisions. We'll also discuss in-the-money, ITM, and out-of-the-money, OTM options. These terms describe whether an option would be profitable if exercised immediately. Mastering these key terms will provide you with a solid foundation for understanding how options work. The strike price is the heart of an options contract. It's the price at which you have the right to buy or sell the underlying asset. When you buy a call option, you're betting that the stock price will rise above the strike price. Conversely, when you buy a put option, you're hoping the stock price will fall below the strike price. The strike price you choose depends on your market outlook and risk tolerance. Every option contract has an expiration date. As the expiration date approaches, the value of an option generally decreases, known as time decay. Think of it like an ice cube melting. The closer it gets to melting completely, the less value it has. Understanding time decay is essential for managing your risk and maximizing your profit potential in options trading. By carefully considering the time remaining until expiration, you can make more informed decisions about when to enter and exit trades. In the money, ITM, and out of the money, OTM, describe whether an option would be profitable if exercised immediately. An option is ITM if exercising it would result in a profit. For example, a call option is ITM if the stock price is above the strike price. A put option is ITM if the stock price is below the strike price. Understanding whether an option is ITM or OTM is crucial for evaluating its potential profitability. Now that you understand the basics of options, let's explore some common trading strategies. We'll start with 4 basic options strategies: long call, long put, covered call, and protective put. These strategies are relatively simple to understand and execute. Remember, options trading involves inherent risks. With careful planning and execution, these basic options strategies can help you achieve your investment goals. The long call strategy is the most straightforward options trading strategy. It's a bullish strategy that profits when the underlying asset's price goes up. You buy a call option when you believe the price of the underlying asset will rise above the strike price before the expiration date. If the stock price rises above the strike price, your option will be in the money, and you can make a profit. However, if the stock price stays below the strike price, your option will expire worthless, and you'll lose the premium you paid. The long put strategy is the opposite of the long call strategy. It's a bearish strategy that profits when the underlying asset's price goes down. You buy a put option when you believe the price of the underlying asset will fall below the strike price before the expiration date. If the stock price falls below the strike price, your option will be in the money, and you can make a profit. Like the long call strategy, the maximum loss for a long put strategy is limited to the premium paid. The covered call strategy is a neutral to slightly bullish strategy that generates income by selling call options while simultaneously owning the underlying asset. It's suitable for investors who expect the underlying asset's price to remain relatively stable or experience a moderate increase. By selling the covered call option, you're obligated to sell your shares at the strike price if the option buyer exercises their right. If the stock price stays below the strike price, the option will expire worthless, and you keep the premium as profit. The covered call strategy offers limited profit potential, but provides some downside protection from the premium received. Congratulations! You've mastered the basics of options trading. Now, it's time to step up your game with advanced options strategies. These strategies allow you to fine-tune your trades and manage your risk more effectively. The more you understand about options, the better equipped you'll be to navigate the markets and achieve your investment goals. Let's explore some of the most popular advanced options strategies. Straddles are a great strategy for volatile markets. A straddle lets you profit from big price swings regardless of the direction. To execute a straddle, you buy both a call option and a put option with the same strike price and expiration date. If the stock price moves significantly, one of the options will be profitable, offsetting the cost of the other. The key to success with straddles is to identify stocks expected to experience high volatility. Section 3. Iron condors. Capitalizing on calm markets. Iron condors are the opposite of straddles. They're designed to profit from markets that are expected to remain relatively calm. This strategy involves selling options and collecting premiums, hoping the options expire worthless. To set up an iron condor, you sell an out-of-the-money call option and an out-of-the-money put option with the same expiration date. You also buy a further out-of-the-money call option and a further out-of-the-money put option as protection. This creates a narrow profit range within the strike prices of the sold options. Your maximum profit is limited to the net premium received. Iron condors require careful planning and monitoring, If the market moves significantly against you, your losses can be substantial. It's crucial to have a sound risk management plan in place. Section 4. Butterfly spreads. Betting on minimal movement. Butterfly spreads are a neutral strategy that profits when the underlying asset's price remains relatively stable. This strategy involves buying and selling multiple options contracts with different strike prices, but the same expiration date. There are two main types of butterfly spreads: long butterflies and short butterflies. A long butterfly spread profits if the underlying asset's price stays close to the middle strike price. A short butterfly spread profits if the price moves significantly away from the middle strike price. Butterfly spreads are often used to capitalize on low volatility environments or to hedge against potential price swings around events like earnings announcements. These strategies can be complex to understand and implement. It's essential to have a thorough understanding of options pricing and risk management before trading butterfly spreads. The highs and lows of leverage. Options trading can amplify your gains, but this potential for high returns comes with increased risk. Leverage means controlling a large amount of stock with a small investment. This leverage can work against you too. If the stock price moves against you, your losses are magnified. Understand and manage risk when trading options. Approach with caution and a clear understanding of the risks. Section 2. Time decay. A race against the clock. Time decay is a critical concept in options trading. It's the gradual decline in an option's value as it approaches its expiration date. Think of it like a melting ice cube. The closer it gets to melting completely, the less value it has. This means time is literally money. As the expiration date approaches, this time value erodes. This decay accelerates as the expiration date draws nearer. Section 1. Scenario bullish on tech. Let's say you're bullish on a tech company called Innovate Inc. Their new smartphone is about to launch. You believe the stock price, currently at $50, will rise significantly. You decide to buy a call option. The strike price is $55, expiring in 1 month. If Innovate Inc.'s stock soars to $65, your option is in the money. You then sell them at the market price of $65. Your profit is $700. However, if the stock stays below $55, your option expires worthless. You lose the $300 premium. Section 2. Scenario hedging your bets. Imagine you own 100 shares of Steadicorp. The stock is trading at $100 per share. You're worried about a market downturn. You buy a protective put option. The strike price is $95. If the market drops, your put option acts as insurance. You sell your shares at $95, limiting your losses. These examples demonstrate the power of options. They can amplify gains and limit losses. But remember, options trading carries inherent risks. Never invest more than you can afford to lose. Options trading is not suitable for everyone. Before you begin trading, it's crucial to have a solid understanding of options, strategies, and risk management techniques. Start with small trades as you gain experience. Consider using stop-loss orders to automatically exit trades if they move against you. Diversify your portfolio and never put all your eggs in one basket. Options trading can be a valuable tool for achieving your financial goals. Approach it with caution, knowledge, and a well-defined plan, and you'll be well on your way to successful options trading. Now that you understand various options strategies, you need to know how to choose the right options contracts. This is where the options chain comes in. Think of it as a menu for options traders. An options chain lists all available options contracts for a particular underlying asset. It displays crucial information for each contract. This includes the strike price, expiration date, bid price, ask price, and volume. The options chain can seem overwhelming at first glance. But once you understand how to read it, it becomes an invaluable tool. You can use it to compare different options contracts and find the best ones for your trading strategy. When navigating the options chain, consider your market outlook, risk tolerance, and investment goals. Are you bullish or bearish on the underlying asset? How much risk are you willing to take? What is your profit target and time horizon? Options Greeks are like vital signs for your trades. They're statistical measures that help you understand an option's price changes. These include delta, gamma, theta, vega, and rho. Delta measures price movement, gamma shows delta change, theta reflects time decay, vega measures volatility, and rho indicates interest rate sensitivity. Understanding these Greeks helps you make informed trading decisions. In today's digital age, options traders have access to a wealth of tools and resources. These tools range from sophisticated trading platforms to user-friendly options calculators. A robust trading platform is invaluable, offering real-time data and advanced charting. Options calculators simplify complex pricing models, helping traders assess risks and rewards. They are particularly helpful for visualizing break-even points and profit potential. A wealth of educational resources is available to help options traders expand their knowledge and refine their skills. These resources cater to traders of all levels, from beginners to seasoned professionals. Reputable online brokers provide articles, tutorials, webinars, and simulated trading environments. These resources offer insights into options trading concepts, strategies, and risk management techniques. Options trading can be lucrative, but it's easy to make mistakes, especially for beginners. One common mistake is over-leveraging. Leverage can amplify gains, but it can also magnify losses. It's crucial to understand the potential risks of each trade. Never invest more money than you can afford to lose. Start small and gradually increase your position size as you gain experience and confidence. Another common mistake is ignoring time decay. Options have a limited lifespan. Their value erodes as expiration approaches. Failing to account for time decay can significantly impact your profits. Always be mindful of the expiration date when selecting options contracts. Choose options with enough time for your trade to work out. Factor in time decay when setting profit targets and stop-loss levels. Options trading is a regulated activity. It's essential to be aware of the legal and tax implications. These vary depending on your jurisdiction. In the United States, the Securities and Exchange Commission, or SEC, regulates options trading. Options are considered securities. This means they're subject to specific rules and regulations. Before you can trade options, you'll need to open an account with a brokerage firm. This firm must be registered with the SEC. You'll also need to meet certain eligibility requirements, such as a minimum account balance and trading experience. It's crucial to understand the tax implications of options trading in your country. Profits from options trading are generally taxed as capital gains. The specific tax rate depends on your income level and how long you hold the option. Consult with a qualified tax professional to ensure you're in compliance with all applicable tax laws. Imagine setting off on a road trip without a map or GPS. You might eventually reach your destination, but you'd likely encounter unnecessary detours and wasted time. Trading options without a plan is like that aimless journey. A trading plan acts as your roadmap, guiding your decisions. It outlines your investment goals and strategies. Without a plan, you're more likely to make impulsive decisions. Start by defining your investment objectives. Are you aiming for short-term profits or long-term growth? What is your risk appetite? How much capital are you willing to allocate? Answering these questions helps tailor your strategies. Establish clear entry and exit rules. Don't rely on gut feelings. Base your decisions on technical analysis or research. Identify specific triggers for your trades. Predefined rules help remove emotions from decisions. The options market is dynamic and constantly evolving. Staying informed about market trends and company-specific news is crucial. Failing to stay updated can jeopardize your trading capital. Follow reputable financial news sources. Subscribe to newsletters, set up alerts, and listen to financial podcasts. Stay abreast of company-specific events. Pay attention to earnings announcements and regulatory rulings. Engage with other traders for valuable insights. Join forums, webinars, and connect on social media. Continuous learning is key to success. We've covered a lot of ground in this guide. You've learned about call options and put options. You understand key terms and trading strategies. You're now equipped to navigate the exciting world of options trading. Remember, options give you flexibility. You can profit in various market conditions. You can use options to protect your investments. You can also use them to generate income. But options trading isn't a get-rich-quick scheme. It requires knowledge, discipline, and a well-defined plan. Approach options trading with caution. Always be aware of the potential risks. Never invest more than you can afford to lose. Start small. Gradually increase your position size as you gain experience. With careful planning and execution, options trading can be a valuable tool in your investment arsenal. Options trading is a journey of continuous learning. The market is constantly evolving. Staying ahead requires dedication and knowledge. Use available resources. Read, attend webinars, and engage with other traders. The more you know, the better your trading decisions. With the right mindset, you can navigate the options market successfully. Options trading offers incredible potential. Embrace the challenge and achieve your financial goals. Be sure to like and subscribe if this video helped in any way.